Analysis of financial institutions operate under a fundamentally different business model than most companies. They rely on confidence and liquidity to function. Banks take in funds that can be withdrawn quickly and invest them in assets that mature slowly. This transformation is profitable, but it also creates risk. Because of this structure, traditional analysis designed for industrial firms often fails when applied to banks. Leverage is not an exception. It is the norm. Understanding banks begins with recognizing that their balance sheets are built around managing risk rather than producing goods. Banks generate income primarily through the spread between what they earn on assets and what they pay on funding. Interest income and interest expense dominate the income statement. Credit losses are an unavoidable part of this model. Expected losses are recognized through provisions, which directly reduce reported profitability. Non-interest income and expenses matter, but they sit alongside a core engine driven by lending and funding. Small changes in credit quality or funding costs can materially affect earnings, even when volumes remain stable. On the balance sheet, loans and investment securities dominate assets. Deposits and wholesale funding dominate liabilities. Equity serves as a buffer against unexpected losses. Because banks are highly leveraged, small asset impairments can have outsized effects on equity. Risk takes many forms. Credit risk arises when borrowers fail. Liquidity risk emerges when funding dries up. Interest rate risk appears when assets and liabilities reprice at different speeds. These risks interact, making bank analysis inherently multidimensional. The core insight is that banks must be analyzed through the lens of resilience. Capital ratios measure loss-absorbing capacity. Liquidity ratios measure short-term survival. Profitability matters, but stability matters more. Regulatory requirements are not constraints added from the outside. They are responses to fragility embedded in the banking model itself. Meaningful analysis requires understanding how risk, leverage, and regulation combine to support or undermine confidence. Without that perspective, bank financial statements can appear deceptively simple.